Welcome, Janus. How are you?
I'm good. It's good to be here. Setup is very nice. So, yeah.
Thank you.
Yeah.
I appreciate that. Yeah, I'm doing my best with my Bitcoin in studio setup. You are my second in studio guest for Bitcoin Rails, the Bitcoin Rails podcast. And welcome.
Thank you. Yeah, thanks for having me.
It's really you were at the very, very top of my list of guests that I wanted to have on from day one. I was sort of starting with the Bitcoin educators, right? The folks who have been, I think, most committed publicly to you know, like really cranking out critiques, talking about what's being built, looking at things from the most neutral perspective possible. We had Nifty was my first guest. Bob Bodley was my second. And yeah, you were my second in studio guest, so I'm
Cool.
excited to have you here.
No, yeah, I'm glad to be here. Yeah, Nifty's great. Yeah, Nifty's actually an advisor to our company. So I've chatted with her a few times.
This is Bob Bodley now.
Bob helps us with a lot of stuff. I'm trying to convince Bob to
Okay.
get on. Yeah. So hopefully Bob can support us with some more stuff. He's been great. He's like helped us with a lot of like really cool like comms initiatives and the frameworks and reviews and stuff like that. But yeah, they're both great. Love them both.
Yeah, they're awesome. But I'm curious. You have like a little bit, I think each of the three of you have sort of like a different story of how you kind of came up in this space and how you got to become sort of like Bitcoin educator types in this sort of Bitcoin season 2 area that we're in. The core, focus of this show is obviously exploring all of this new tech, this deluge of new tech that I call it since ordinals, basically. Like in a post-ordinals universe, we're seeing all of this new investment, all of this new growth in this sort of Bitcoin ecosystem, as it's called, which is funny. Like, I didn't even know that was a term. I mean, this is a new term, I think, the Bitcoin ecosystem. How did you get involved in this whole conversation? Like, what's your background in this?
So like it's very funny because a lot of my current research is on like wrapped or derivative versions of Bitcoin and how those are used across like a number of different like EVM blockchains. But I am much more interested like personally in Bitcoin as just like a hard money and like a peer-to-peer type digital cash. Like pretty regular user of Lightning and like different applications that support Lightning on like a weekly basis, I would suppose. But I think the reason I got into this is I was working on a blockchain called Zcash, which is a it offers like, it's a monolithic blockchain that offers like privacy preserving payments. And I had some issues with the way that Zcash did their token issuance. So I kind of looked at the Bitcoin model with this like fair launch. Everyone who's been issued tokens earn them from, mining, like from proof of work mining. So I was like, that's like a very fair issuance and you need that to be like a credibly neutral hard money. So while I was working on Zcash and like kind of looking at other things, someone named John Light, who's the technical product lead at Alpine Labs, released a paper on how you could do ZK rollups on Bitcoin, or validity rollups on Bitcoin, which is like the more technical term, but people call them ZK rollups for like more marketing purposes, I guess. So he released that paper and I was like, oh, cool. And he mentioned like in the paper, you could do like Zcash style execution environments and have these like trustless bridges with Bitcoin. At the time, kind of based on a few opcodes that would be additionally added to Bitcoin script. But I was like, that's really cool. So I got really nerd sniped into rollups and corresponding infrastructure. So I worked in Ethereum for a little bit at Espresso Systems and got more acquainted with how rollups work and how modular blockchains work. And from there, I started writing about how they could work on Bitcoin. I think I was maybe the first person outside of John Light and a few others to like actively write about Bitcoin rollups. And after that, people were like, you should review these things against a framework and analyze them because there's this site in Ethereum called L2 that does a great job at analyzing like Ethereum rollups and their trust assumptions. And people were like, well, if you're writing about rollups on Bitcoin, you should try to analyze them as well. So it's been this like very long, I'd say 2.5 year journey of like getting nerd sniped by rollups through John Light's paper. And then learning about them and working on a project that supports rollup infrastructure. And then from there, writing exclusively about how they could work on Bitcoin.
So just for clarity, so before you went to Espresso, which is in the Ethereum ecosystem, you were already interested in specifically building zero knowledge proofs on Bitcoin? Like you went to Ethereum because you wanted to...
In my interview at Espresso, I remember telling like the co-founders, like the only reason I'm interested in this at all is because I want to see how these work on Bitcoin. They thought I was crazy, which is really fun. But yeah, they gave me a shot to work there, and like I owe a lot to them. But yeah, that was the reason I worked
It
there.
is interesting though that, that was the place to go if you wanted to understand ZK proofs. I mean, and ZK rollups.
Yeah, just like even corresponding infrastructure, like understanding like what sequencers are and prover architectures and like different data availability layers. Like people hear this like term like Bitcoin L2 and like they think about all of these new things that are coming out, and there's so much of like that's going on behind the scenes within these architectures that you kind of have to understand how they work, which is really, really fun and really interesting. And like Espresso was a great place to go and be exposed to that. And it's been really cool because actually two of the co-founders at Espresso, like the really technical co-founders, have actually released research papers in like the last 3 to 4 months about how different things, like one wrote specifically about different like implementations of ZK snarks and how those could support Bitcoin. And then another wrote about like using Bitcoin as a data availability layer and some modifications you could do there. So yeah, it's been really cool to actually see people at Espresso like write about this category as well.
So you started reviewing specifically ZKPs, like these ZKP style bridges initially, and then you expanded to kind of looking at and analyzing other layer 2 architectures outside of zero knowledge proofs. Is that accurate? Or how?
No, so I actually like obviously if you just heard my explanation of like like how snarks work on Ethereum, I'm not a cryptographer. So my understanding of snarks and what they can be useful for is like very, very limited, and kind of like at a very high level, what what the proof is basically doing, the zero knowledge proof, is essentially just convincing a bridge that the state of a specific blockchain is true. Like this is the state. I'm convincing you that this is the state, and that you should release withdrawals on the layer 1 based on this argument that I presented to you. So it's just like trying to convince the bridge that something on the L2 happened, right? So that was like kind of like all I really needed to know, and basically getting a lot of social proof from like other cryptographers and really smart people of like, yeah, this is like a possible thing. This is something we could do. And kind of just looking at that of like, well, if we had like the Zcash style execution environment, the best money to use that with would be Bitcoin. So if there is a way that's possible to bridge Bitcoin onto this environment in the most trust minimized way possible, then I was like, okay, I'm going to start researching that and looking into that. So that's why like I got really nerd sniped from John Light's paper about all of this. But I think the way everyone is describing rollups is wrong, and that's another conversation. But yeah, like so people like are associating rollups and bridges together, and they're sometimes different, and there's a lot of different trust assumption and trade-off that you can make within the design. But like that's like the key thing that I think is like really cool.
Okay, so this is a great question because I asked Nifty and Bob also this question, what is in layer 2? And of course, they had different definitions based on their sort of personal points of view about what a layer 2 is and how it should be defined, and if that's even something that we need to do. How would you define a roll-up?
Yeah, a rollup is like actually a really easy definition. A rollup is a blockchain that uses another blockchain for data availability. That means that every kind of certain period of time, the rollup blockchain will submit a summary of all of the transactions that happen on the rollup to a parent blockchain. And then the rollup nodes will scan the parent blockchain and apply something called a state transition function, which is essentially just logic that updates the state of the rollup. And they compute the new state root, which is like the agreement that this is like the new state of the rollup.
By that definition, is Stacks a rollup? Because doesn't Stacks post like a hash of their state on the base layer of Bitcoin?
Yeah, that's a great question. So Stacks is not a rollup because it only posts the transaction hash. Or like,
okay, so it has to be more than just the.
It has to be like essentially this,
like the full state.
The full, like essentially the full state, or something called a state differential. But like that's another kind of like that's another implementation of that rollups can use. But like essentially the full state that allows you, if you're a Bitcoin full node and you wanted to reconstruct the entire state of this blockchain, you could do it from the data that's posted in Bitcoin. You cannot do that with Stacks. You would need to run a Stacks full node to be able to do that. So the idea with rollups is that you only have to run a Bitcoin full node to be able to like reconstruct the state.
Okay, so this is a non-controversial definition.
This is
widely accepted definition of a rollup.
Yeah, everyone accepts this is the definition for a rollup.
What's your definition of a layer 2 then, which is a more controversial question, perhaps?
Yeah, I think a layer 2 is something. I think a layer 2 is actually a really bad definition.
Like we shouldn't even use
we honestly shouldn't care, because a layer 2 is a off-chain system that you basically deposit Bitcoin into. And in the event that the system fails, you by yourself can get your Bitcoin out. The only systems, to my knowledge, that provide that are validity rollups, optimistic rollups, and
Lightning.
Lightning. So, and I think there's other arguments for like Arc and state chains, but we can talk about this later. But like the main three that I think of as like layer twos are those systems. And when I
And of those three, Lightning is the only thing that's actually
that it
functional.
actually exists, but like additionally, like validity rollups and optimistic rollups, in the way that we know them in other kind of ecosystems, are not essentially not, in my opinion, not possible on Bitcoin. We'll focus on the validity rollup side because that's what everyone's talking about. The reason validity rollups aren't possible in Bitcoin because a snark verifier and like Bitcoin script would be like, I think 1 gigabytes worth of data. So that's like that's too much data to put into a Bitcoin block. So that's why we do the BitVM game to like break that up into chunks. But the idea of unilateral exit with that type of system today is not possible. So the only thing that is a layer 2 today is Lightning. But I still think that that is a bad way to look at these systems because there's other things that are involved when a user is depositing funds, and there's other trade-offs and trust assumptions. So for example, like with Lightning, it's a payment channels based system, state channel based system. So you have to initiate an L1 transaction in order to create a channel with a counterparty. So what happens when like we get another ordinals craze and the price of Bitcoin's really high and like the fees to do that are so astronomical that only like a select few people can like afford it. Then layer twos are essentially now these systems that can only be kind of leveraged by people with large amounts of Bitcoin or people who are willing to pay large amounts of fees to enter into the system. So that's why I think like other sidechain style systems, while they might not be a classical like layer 2, are still like really useful things to build. And I'm kind of more interested in analyzing like different parts of the system in isolation of each other versus trying to like create this definition of a layer 2 that no one's going to agree on anyways, right? Like you got like people think stacks is a layer 2. People think that BitVM rollups, which are coming into production, are going to be layer 2s. People only think Lightning's a layer 2. And it's just like, it's an argument that's been going on for years. It's an argument that's going on in Ethereum. It's an argument that's going to be going on in tons of other ecosystems. And it's just like, we don't even need to like have that argument. Just need to argue about the individual trust assumptions of a system and what those are specific to users when they put money in it.
It's interesting you bring up Lightning because I think a lot of people right now are sort of, it's like in the air that people are kind of poo-pooing Lightning a little bit. Like Lightning's like struggling with their narrative a bit. I'm curious, if you have an opinion about why that is. Is that because of these sort of technical challenges and sort of liquidity fronting challenges that you've mentioned? Or is it just that payments as a use case is not being adopted? I mean, that's something else that might be like an elephant in the room. I feel like most people aren't really talking about.
Yeah. So I did write the Lightning review for Bitcoin Layer, so I understand it at like a relatively like high level, but it's not my strong suit from a technical perspective. So I don't really feel confident enough to like say these are the things that are technically wrong with Lightning. I just think like the fact that you have to do like an L1 transaction is a huge hindrance. So like if you remember like in the last ordinals craze, there was this dialogue between one of the Taproot Wizards people and someone who does like, Bitcoin adoption in the global South. And they were arguing about like, well, these ordinals are really problematic because I can't onboard people into self-custodial Lightning and I have to have them use custodial solutions because they couldn't afford that L1 transaction. The argument there is like, then we should do things like better sidechain designs or rollups or those types of solutions because you don't need an L1 transaction. So if I were to send you money on Arbitrum, which is an Ethereum rollup, all you have to do is spin up a MetaMask, add Arbitrum to your wallet, and then I just send you money there. You don't have to do like an L1 transaction. You don't have to create like a channel. You don't have to manage liquidity, like all these things. So that is like, I think the big like hindrance. I think though Lightning, as like how I've described it, and I think it's really cool, is like anywhere I go in the world, any country that accepts Bitcoin for payments they have like a BTC Pay server. And like, it's like this universal, like I'd say like point of sale system. And that's really cool, right? Having like the ability to integrate with the system and pay invoices for anything from whether that's a Fediment wallet, an eCash wallet, a Phoenix wallet, a custodial Lightning wallet, a self-custodial Lightning wallet, that's like really cool. And then you look at projects like Citria who are building a rollup on Bitcoin. They've shown on testnet the ability to like pay Lightning invoices directly from Citria. So like that's like a functionality they're thinking about integrating with. So I still think there's a place for it, and I think there's a place for it acting as like somewhat of like a not an interoperability system, but a way for people potentially to do atomic swaps between these different protocols, which I guess is an interoperability system. But I think that that use case of having it be like this global kind of like accepted and widely used like payments system is like actually like still really useful, because all these other systems can integrate with it, and they can, you know, pay invoices through some roundabout way. So I think that's pretty cool. But I still would say that from a trust assumption perspective, it has a lot of problems. Yes, 90% of the usage of Lightning is done through custodial providers, or 85%-ish. But it is still, from what I can tell, there's another Fuel V1 on Ethereum, which is another example of this, but it's one of the very few examples of an actual in production layer 2, to where if the system like broke, you could get your money out on the Bitcoin L1 or on the layer 1 blockchain of any respective blockchain. It's one of the few things that actually provides that today. So I still think that should be celebrated a little bit.
That is the case, up to a certain number of users, right?
It doesn't scale. It doesn't scale.
Okay.
Yeah. So that way it's like we need to think about different systems in different ways that these systems can interact with each other past the L1. And I think rollups are a solution. Different types of sidechains are solutions. But yeah, we just have to like think creatively about all that stuff.
I was going to ask, like, what do you think is your favorite alternative to Lightning, or most promising alternative to Lightning for payments as a use case specifically? And I do want to talk about some other use cases for these technologies, but for payments specifically, what do you think could potentially replace Lightning, and kind of solve some of the problems that Lightning is dealing with right now?
So I think shielded CSV is a paper released by, it was Nick Jonas, Liam Egan, and Robin Linus. Like I think that's like a promising idea. Is essentially is a type of like protocol that it leverages like snarks and validity proofs, but instead of like posting all of the state data to the blockchain, a user just holds their own state client side. So it's a client side validator protocol. But the cool thing about it is because with these client-side validated protocols, like the state can grow quite large, because you're storing the state relative to like every token and every contract and every like transaction you've ever done, you're storing that state. That can grow quite large. So what shielded CSV does is it implements validity proofs to make that state constant size. So you're just storing like a constant amount of data, and you're also using snarks to do like private transactions.
Is anyone working on an implementation of this, or is this just a theoretical paper?
I think it's theoretical, but I think some teams have like lightly mentioned that they're exploring implementing it. And the cool thing about shielded CSV, like one of potentially, I guess you could call it an issue, is that it relies, like you have to post a commitment of the transaction to consider it finalized. And that commitment gets posted to Bitcoin. So people were saying like, oh yeah, that's like 10-minute block times. That's really quite slow. And like for a global payments use case, like, people aren't going to wait 10 minutes to like buy coffee or buy something, whatever, right? So what you could do is you could actually integrate something like that with a rollup, right? So rollups have their own blockchain and their own operators, validators, miners, whatever you want to call them. And they produce blocks much faster. So they produce blocks like every 2 seconds or 4 seconds, and offer this thing called a pre-confirmation. So basically a pinky promise that your transaction will be finalized on the L1 eventually. You can wait the 10 minutes or an hour or 24 hours, whatever, however often the rollup posts that batch of transactions. But as long as you trust the sequencer, you can consider that finalized. So for like a $5 payment, where I'm like sending you money for like coffee or a drink or whatever, I can pay you through this the shielded CSV protocol. It can be integrated, let's say, with a rollup. So I'm just sending my commitment to the rollup sequencer. The rollup sequencer takes that as like, here's a pinky promise that I will send this to Bitcoin on your behalf, and then it eventually sends it to Bitcoin.
Do you need that technology though? Couldn't you just theoretically replace this payments problem just by using a rollup directly? Like, couldn't you just use like, Alpen Labs rollup when that becomes live, and just use atomic swaps and for people to get in and out of Bitcoin?
So the problem with doing that is Bitcoin is quite limited in its throughput, or the amount of block space that's made available every 10 minutes. So the maximum amount of data that you can post to Bitcoin is 4 megabytes. And these rollup batches are actually quite large. So let's just say it's like for every rollup batch that's posted, every 24 hours, that's how like often the rollup decides to like post its state to Bitcoin. That's like, let's say it's 1 megabyte of data. Like if blocks are being are full and are being with tons of other transactions, or there's competing rollups trying to get their corresponding batches like posted at the same time, then you get into like bidding wars, and like it becomes quite expensive, and that cost is incurred onto the user. So rollups on Bitcoin specifically can only offer like 15 to 20x scale and throughput. So it's better than the L1, but it's not the most scalable system. And for peer-to-peer payments, where you want maybe transactions to be like a fraction of a cent or 2 cents or whatever, it's not the long-term best solution. So like a Zcash style rollup, if you were to do that on Bitcoin, it still has like that concept of like global state. Whereas like shielded CSV, all of the state relative to everyone's token balances is kept client side. So there's not that data availability problem that you have with rollups that you would have with shielded CSV.
And
So I think using them complementary is actually like an interesting idea that people have thought about. And I know like Alpen Labs team has like thought about that and talked about that publicly.
well, Liam, who you said was the author of this add-up,
Yeah, exactly.
that makes sense.
Yeah.
This seems like specifically for payments, this is a use case where you really need a ton of throughput, you need speed, right? These are like requirements, so that makes sense. I'm curious to hear a little bit more about what you think sort of the best tech options are out there for other use cases that, maybe Bitcoin maximalists have been kind of neglecting, like lending or other kinds of sort of DeFi related use cases, if there are any that you think are particularly valuable or that are actually going to be, legitimate and worthy of consideration. What do you think about other use cases and how these techs will be used?
I'm not really sure. I think like the ability to do, for example, on more expressive like blockchains, you could do things like tornado cash, like privacy mixers on these chains to like, add some privacy and add some kind of, if you are doing a bunch of transactions on like an EVM rollup and you throw it into tornado cash and then you anonymize it and pull it back out to add a like extra level of anonymity to your funds, I think is interesting. I think like Bitcoin backed stable coins could potentially be a use case. And there are protocols on Ethereum. I think one's called Liquidity Finance, that are trust minimized, where the stable coin isn't backed by like dollars held in some bank or treasury notes held by some kind of like centralized US based company. It's all done. All the collateral is right now it's on Ethereum. So the collateral is ETH. So if you did that in Bitcoin, you could set like collateralization rates based on these loans, and you could loan Bitcoin to get stable coins in return. That's like a pretty cool use case. That like there's other ways to do that. Like there's a protocol called Lava Loans that uses DLCs to have that same type of functionality, although they have different trust assumptions based to like kind of rollup based protocols. So
Are they live yet? I just learned about
live
is a founders fund investment. I'm pretty sure.
founders fund, but
And they like enable lend. I mean, I'm very excited about the lending use case personally, and I think that they have like reasonably low interest rates. I mean, it seems like they're doing something that is very, very useful for anyone who doesn't want to sell their Bitcoin and wants to get, stables out as collateral. I mean, is there any competitors to them that you're excited about?
So I think they're the main one doing the DLC based loans right now. They're like the big one that I think people are really excited.
Liquidity and ordinals, and the ordinals for if you want to get lending against your JPEGs, then Liquidium is doing something similar with DLCs.
But yeah, like they're the big one, and then people have like recently Bedlam Research, which is a pretty cool like research group. They released like a blog post kind of saying that the borrowing and lending protocols have stronger trust assumptions on rollups, which was kind of disputed by a few other people. There's an argument there on Twitter, but it's just trade-offs, right? I think those are like the big use cases in my opinion, right? I think, and then to be completely candid, like people don't like this, but like people are going to build shitcoin casinos on these things.
Yeah.
And like my opinion of it is like, I'd rather have people deposit Bitcoin into a shitcoin casino that they can get their money out if they wanted to, versus like trusting some 3 or 5 multisig or some custodian to give it back, right?
One of the biggest problems with the shitcoin casinos right now is just straight up custody issues. Right?
I mean,
Ultimately.
but that's the problem with any of these systems that are currently in production that classify themselves as Bitcoin layers or outside of Lightning and state chains. I don't think there's any implementation of Arc live, but Mercury layer is live, Lightning is live. Outside of those two protocols, everything else is, yeah, you're trusting somebody, whether it's a distributed signer set like ICP's CKBTC or TBTC that uses Ethereum as its accounting layer, or a straight up custodian, like a number of these implementations. That's the biggest issue, that you're depositing Bitcoin, you're giving it to someone, and you're getting an IOU that's like, oh, you're going to get your money back if you ask for it. But there's no way for you to contest them if they try to steal your money. There's no way for you to, like, there's not really many implementations to know that they have the actual reserves backing the tokens that they're issuing. So this is kind of the problem with a lot of stuff that's not ordinals or BRC20s or runes trading on the L1, is that every kind of implementation of Bitcoin Season 2 relies on some custodial party. And that's, I'd say, kind of the over like arching issue of this whole ecosystem.
I want to dig a little bit deeper into that. You mentioned ICP. So I think a big meta, arguably the biggest meta of sort of Bitcoin Season 2 on the layer 2 conversation is just like, what degree of trustlessness or trust minimization is your protocol offering? And there's a handful of different types of technologies that are sort of promising different trust assumptions. One of them we've talked about is ZK proofs, the BitVM style ZK proofs, which we'll put a pin in. But the other is this like, basically like nodes of other blockchains, sharding and putting back together keys like chain key Bitcoin. I think Arch is doing something similar where you have like Arch validators essentially executing Bitcoin transactions based on the validity of smart contracts. What do you think of that style of Bitcoin layer 2?
So there actually ICP and Arch are actually, from my understanding, are pretty similar. So they both offer essentially virtual machines that can interact with like pre-signed Bitcoin transactions. So if you wanted to do a swap on the Bitcoin L1 and have that logic executed by like Arch validators, that's possible. And technically, you don't have to bridge your funds over, and that transaction for the user is trustless. And ICP offers that same functionality. Where the trust assumption typically comes in is whether you're a liquidity provider or a user that doesn't want to wait on like L1 confirmation times. You will lock your money into like an L1 vault that's operated by, that's basically a Bitcoin wallet that has the validators of the other blockchain basically doing that key signing mechanism. And then you get like a version of Bitcoin on those blockchains. My personal opinion is like ICP is like a really good example because it's in production. So how ICP does it is they have this governance system that is like, I think token weighted, or not exactly sure, I don't remember, but like I think it's token weighted governance, and like all these people like vote to approve proposals. And all of the validators have to go through this like know your business disclosure process, and they have to have like certain hardware they have to meet certain hardware requirements. I think the nodes have to be operated in like a certain, there's like a standard on the warehouses that they have to be stored in. So like these are like professional setups for people running like ICP validators. And specifically to this subnet that you were mentioning, it's 34 validators. It used to be 28, and the signing was 10 out of 28 validators needed to sign to create a valid signature. I'm imagining it'd be like 15 to 34 or something, 16 to 34 or something like that now.
And I think it might even change.
Yeah,
like it might even depend on the situation of like what's being signed or what.
So to like sign a withdrawal, like, or burn transaction and release funds on Bitcoin, I think it's a constant like
It's always 36.
Yeah, it's some number of 34. So let's say it's 15 or 16 to 34. So 16 of these validators need to come together, produce a signature to like validate this transaction withdrawal request. It's not the best, like, maybe 2/3 assumption is probably a bit better, but like these are like professionally known operators. They have, they don't stake collateral. So maybe that's like something that you could say against ICP, but they are like known to go through KYB business processes. And like, if they were all to come together and steal the money, that like is a huge dent in their reputation. The reason why that is like, I would say one of the better implementations right now, because that's like best we can do. Like outside of BitVM, right? Like this is the best we can do. We can create like NPC protocols or big multisigs that run really fancy hardware, or a combination of both in some way, and have all the people operating that protocol disclose who they are, maybe stake some token to have some skin in the game. So I know Arch is like planning on having their validators like have some stake associated with being a validator. So like if they were to steal Bitcoin, maybe that's a slashable offense and they get slashed some money for doing a malicious act. Like this is the best we can do. And to be like really blunt, like I think just creating like some standard disclosure process that kind of everyone adheres to would bring a lot more transparency and trust into the ecosystem versus what we're at right now. Because right now we candidly have no idea what's going on. So that's kind of why I think things like ICP, I know TBTC does something pretty cool. The SBTC Federation that just got released was like pretty well done. Rootstock's RBTC is well done. Yeah, those things are like things that most projects should like try and strive to be, in my opinion.
When you're like kind of ranking L2s, or when you're reviewing, maybe when Bitcoin Layers is reviewing L2s, is the number one thing that you're looking at the sort of trust minimized bridging ranking, essentially? Like how trust minimized is this thing? Is the permissionless exit the number one thing that you care about when you're looking at, how valid a particular layer 2 is? Like what are you caring about when you review a layer 2?
So there's two things we look at. So we look at layers or kind of any execution environment that supports off-chain Bitcoin transactions, or like derivative Bitcoin transactions. And we look at the actual like derivative assets themselves. So we look at two different things and they each have their own individual frameworks. From a layer perspective, we look at four things. We look at who holds the money that is backing the asset that's being used in the off-chain system. So what essentially is the bridge, for lack of a better term, or two-way peg. We look at who is responsible for storing and making the data available for whatever purpose it needs to be made available for. So like Lightning, for example, you store your own data client side and you have that available. So if you need to submit like a justice transaction or a fraud proof, you have the data available to be able to do that. So who's responsible for that? Who's responsible for operating the network? Is it a single validator? Is it a federation? Is it a decentralized blockchain or a minimally decentralized blockchain? And then lastly, we look at like what is the mechanism at which users can consider like their transactions finalized so that they're not going to be like reorged. So for example, in Botanix, in their upcoming release, they're going to be using a federation, but the consensus mechanism that the federation uses has this thing called single slot finality, which means that once a transaction is included in a block and that block is put in the chain, that transaction can't be reorged. So a user in Botanix can know that once their transaction is accepted into the chain, it can't be reversed. So that's what we look at on the layer side. And for each layer, people are like, oh, there's like one bridge with Bitcoin. But like in practice, what we're seeing is that a lot of these chains have many versions of Bitcoin that live on their specific chain. So for example, Bob, which is a rollup on Ethereum that has like a official canonically enshrined bridge contract with Ethereum. And when users do atomic swaps from Bitcoin into the protocol on Bob, they're swapping for a token that is escrowed in that bridge, that's held in that bridge. Like that's the official bridge. Like that is what most people would consider to review. But the issue with that is that SolvBTC, which is a custodially backed Bitcoin derivative, is live on Bob. And it has more TVL and more volume than the BTC-backed tokens that are stored in the official bridge. So we look at in the review in the custody section, we look at every wrapper in isolation of each other. What's the bridge for that wrapper? Is there on the specific token contract? Is there anybody that can like upgrade the implementations? Like all this crazy stuff that has to deal with the trust assumptions related to that specific derivative.
This is something I don't think people are talking about enough. I mean, this was something that literally just came up between us privately off camera for like 20 minutes ago that I had never even thought about. Like when I think about all these Bitcoin layer 2s, I just assume it's like all this, it's all spot Bitcoin. There's no paper Bitcoin. It's all just, you're just putting Bitcoin into an address and, hoping that you have the best tech that you can get it out But actually, it seems like a good portion of these layer twos are accepting as collateral into their bridges liquid staking token versions of Bitcoin. I mean, am I getting that right?
Yeah. Okay. So this is where so there's a lot of issues with this, right? So for every derivative asset, it's different. So that's why we also look at all these derivative assets in isolation of the layers. So you can there's two reviews on Bitcoin layers. You can look at the blockchains that people use these things on, and then you can look at the specific wrapped versions of Bitcoin that they're using. And every wrap version is
Each
different.
presents risks, basically.
Yeah.
Like you have we talk about the bridging risk in our community all the time, but this is the first time that I'm seriously thinking about what about the risk to the actual assets that are being bridged, because they're not necessarily Bitcoin.
So I hate to pick on Bob because I'm friends with some of them and I like them, but I'm going to pick on them. So they have a bridge, and their bridge is essentially, it can be upgraded by a 4-6 multisig. So you are trusting a 4-6 multisig to not steal all the money. That is essentially the trust assumption for the Bob official canonical bridge on Ethereum. In that bridge, the two assets that are locked that are Bitcoin related are WBTC and TBTC. So at first glance, you trust the 4-6 multisig for Bob. And then for WBTC, you trust BitGo, which is a 2 or 3, which are basically running a bunch of 2 or 3 multisigs between 3 companies. And for TBTC, you trust a protocol called the Threshold Network, which is essentially a protocol. It's pretty cool, but it's made up of ultimately 35 stakers and 35 signers. That's how many people participate in TBTC.
Pretty centralized.
Yeah, I mean, it's more distributed. It is actually, I think, in practice, it is the most distributed two-way peg for sidechains or wrapped versions of Bitcoin. But that is the most we've gotten to, is 35.
That's where we're at.
We're at 35 size. And ICP is 34. And then I think the next biggest is Nomic at 21. And then it's Liquid and Stacks at 15.
It actually kind of brings up this other question that I have, which is is all of this sort of obsession with decentralization for bridging specifically kind of a meme? I think you're the one because you mentioned to me at one point that there's never been a hack of a multisig that required more than 4 signers.
I think it was, there's never been, it was 5. I think it was the Axie Infinity hack, and it was 5 signers. And I think one entity owned 3 of the signing keys. So I think it was only 3 individual entities that got hacked or phished to get their private keys stolen, and then the hack happened.
So this may be a lot of decentralization theater, or is the idea that, as market cap grows, as TVL grows, the incentive to hack these things will become higher and higher and higher, and we'll need more decentralization.
I mean, so there's a lot of arguments, right? There's so much to unpack here. So talking about the bridge problem is that, yeah, when you look at these blockchains, whether they're rollups, whether they're sidechains, there's going to be a number of different derivative assets, and then there's going to be derivatives based on derivative assets. So if you look at, for example, SolvBTC, which at the time of recording is getting a lot of headlines right now. Their token,
because they are a liquid staking token that is being heavily deployed onto Bitcoin L2s right now.
So it's a couple things. It's a derivative asset, and then there's other derivatives of SolvBTC. So there's other so it's a asset, it's a reserve asset.
Layers of paper.
I don't want to, there's layers of each token implementation has trust assumptions. So the problem with SolvBTC is a lot of people are sounding the alarm that it could potentially not have a sufficient amount of Bitcoin reserves. From what I've looked at this week, I'm not sure that's my main concern right now with not just Solv, but a number of these things. My main concern is that, for example, Solv is backed by native Bitcoin and then 8 different derivative versions of Bitcoin. So for example, if a derivative of Solv became unbacked and went to 0, got hacked or something,
but it just triggers a bank run.
Then it triggers a bank run, and then it's a domino effect because Solv then becomes unbacked. And does the team have a sufficient amount of other reserves to cover the loss of that derivative? So it's there's layers and layers and layers.
The derivatives are created by other teams, essentially. Lots of teams building on top of projects, on top of projects, on top of projects.
It just depends on the implementation. So for Solv, for example, they approve certain tokens to be collateral of the SolvBTC. So they approved, for example, TBTC to be one of the collateral tokens for SolvBTC. So it's just derivative.
So the core Solve team has some control over this. They're not,
Yeah, they control everything. They essentially control everything, and the contracts are very centralized. And like if something, I don't know, if like something went wrong, they could probably like pause the contracts and like stop, maybe pause withdrawal permissions or issue an update that allowed them to do that. And then they could pause everything and then try to like make sure that all the derivatives, they would try to stop a bank run essentially. And I don't want to seem like I'm picking on them because, well, I kind of am, but like this is a problem with a number of these new assets. And when we get to a point where we have like trust minimized bridging, let's say BitVM comes out and like Citria or Alpin get to market, or Bob with Fiamma or whoever. Are we actually getting a distributed operator set? And are we getting permissionless fraud proofs? Because what if those implementations start completely centralized? What if they start with a federation of 15 members, but instead of having to trust 11, you trust one? Like it is still in its implementation a federation of 15 members that holds all the money, and they can play the fraud proof game themselves, but like that's like the core implementation. What if you launch completely distributed, but you have a 4 of 6 emergency multisig behind the bridge implementation? Whereas like if something goes wrong with the implementation of the bridge, a team can upgrade it and make it fall back to a centralized group of people so they can pause it and fix it and then like be able to like put it into production again. Like these are all questions that you have to analyze, you have to ask and analyze for all these different implementations. And even in the event that you get, I know I'm going off on like a tangent here, but like,
this is great.
even if you get a trust minimized bridge, you still, is that the bridge that everyone uses? Back to Bob. Bob has an official gateway on its website to take native Bitcoin and do an atomic swap into TBTC on its chain through its official canonical bridge that is owned essentially by the Bob team. But everyone, for whatever reason, if seems to be minting SolvBTC and LST derivatives of SolvBTC on Bob. That is where the majority of the volume is from. So like, even if we have the ability to do these like not even like obviously I would not consider Bob trust minimized, but it points to like the official application and official like use this here from the Rollup team is not always what's being used in practice.
Well, and what do you think is actually driving what's being used in practice, right? I mean, I think this is an important question is, okay, there's all of these ways that you're sort of like grading and ranking and thinking about, what the best implementations are for layer twos. What do you think is actually going to be commercially adopted and why? And is that different than maybe what you would hope would be adopted and used from a theoretical perspective?
So I think from my vantage point, like it's it's a very cynical view, but like I actually think my co-founder and some of our researchers would be way better equipped to answer this, because my current opinion for all this stuff is it's just a massive shitcoin casino. Like, so why would someone deposit their native Bitcoin into this token that can be upgraded by a 4/6 multisig? Well, the reason they're doing that is because they're getting points and they're getting like future potential allocations of airdrops, and they're getting like the potential to like get this new token and then dump that and get more Bitcoin. And it's like a casino game. Um, and kind of the problem though, like, and people are like, oh, well, that's like, isn't like ordinals or runes or BRC20 is like the same thing. And I would argue it's not, because like ordinals is like, for me, you know what you're like getting into, I think. Like
Yeah.
you kind of know, I'm going to buy this thing. I hope it goes up because of memes, but I know I'm doing that. And if I lose all my money, like it's fine. The problem with, I'd say, the other side of the aisle, like with a lot of these L2s and new assets popping up, is that there's behind the scene KOL deals, there's inflated TVL numbers, there's people launching chains and getting listed on marketing sites and then doing public token sales for the community instead of the VCs and then running away with all the money. There's people doing community token sales even though they raised a Series A or seed round where VCs got a much more preferential valuation. And then on unlock, guess who's selling all the tokens onto the public token sales? The VCs. So like I kind of look at like a lot of what's going on in the Bitcoin. I think that's maybe the reason why like people think I'm so cynical online is just because like I kind of understand that everything that's playing out right now is kind of this pump and dump game where people are going to buy all this shit. They're going to put money into all these protocols and they're going to launch a token and everyone's just going to try to get out as fast as possible.
It's a much more sophisticated shitcoinery, but it then ruins our BRC20.
Yeah, it's like, at least the casino is the casino. Like ordinals, I'm not a huge like ordinal person. I don't really know how it works. I've used it, like I've done maybe 2 or 3 transactions with it.
But it's just like retailers buying assets.
Yeah, it's like people launch a bunch of tokens and they buy them and they create memes and the memes make it go up. And it's like, yeah, that is like, you can hate it and you can call it spam, but it, in my opinion, is like way more like straightforward than what's going on in the other side of Bitcoin season 2.
I mean,
yeah,
that makes sense to me. I'm with you there. So this is a great kind of segue into what I'll say is sort of like my final segment I wanted to get into with you, which is just all of these layer 2s launching utility tokens. And you know, I think that there's this argument. I had, again, like I said, David Soroy on this week. He talked about how you really don't need utility tokens for these layer 2s. At the moment, Alpin Labs is not planning on launching a layer 2. Then you have like the Trevor Owens argument, which is that you need utility tokens for all of these different protocols in order to incentivize the validators. You know, where do you fall in this argument in terms of like, are utility tokens necessary, or are they just sort of, you know, rationalizations for VC pump and dumps?
both. So here's where my stance is on the argument. So there's a couple of like layers here. So let's say I'm not going to use any project like as a specific example because I think 98 to 99% of these things are going to launch tokens.
Because they have to technically, or because investors will put pressure on them to?
I mean, yeah, like if you know like I think if the people who are investing in a lot of this infrastructure are people that invested in Ethereum and Solana and Celestia and all these other ecosystems, like the expectation is that they're getting a token warrant. And like a token warrant doesn't mean a token, but it means that there's like a lot of pressure on projects to deliver that. And people can argue with me about that. That's fine. But I'd say 98%.
No, that's real. I mean, I hear that from everyone pretty much.
I don't, again, it's the game, right? So I don't like it. It's not my thing, but let's break it down. So a roll-up can exist with a centralized sequencer. And theoretically, it can create a mechanism to where if the sequencer censored users, it could be slashed, it could be replaced, it could be like the user could force their own exit out of the system. So it theoretically you could do that. In practice, there's like a lot of, you know, what's the word I'm looking for? Like there's
just risks involved with having
not risk. I can't think of the word. It's like a lot of things that just makes those implementations like difficult to do. Like I can't.
Centralized sequencers are different.
Yeah, centralized sequencers are easy to run, but like being able to implement like a forced inclusion and like self-proposing,
being able to solve the problems.
Being able like solve the problem of allowing a user to bypass a sequencer and initiate their own exit is like a very complicated problem to solve, and like only a few projects in Ethereum have been able to do it.
And just for clarity, just for everyone who like might be watching who might not totally know what's going on. So the sequencer is basically what decides which transactions get into a block, actually.
The sequencer is the block builder for rollups. So
if you have a centralized sequencer and you theoretically have an issue where you have centralized control over what transactions are executed. And that's the problem
included and executed in the block. Yes.
Okay.
So you have an issue with, that. So the rollup scenes will be like, oh no, we're going to do forced inclusion and we're going to do eventually like allow users to like self-propose their own blocks so they can become their own block producer for their own transactions. It's like really hard to do. And like, we've never tried it on Bitcoin. So like, I'm not skeptical that it can be done. I'm skeptical at the rate at which like it's going to be implemented.
This is years away. I mean, we're already years away, even just from like a functioning rollup.
Yeah, like a rollup with like a trust minimized bridge implementation. Yeah, we're probably still a few years away, maybe a year and a half. So, but past that is like another issue is with the sequencer is like, and this is an argument I don't like, is they're like, a lot of the rollup teams will be like, whoa, well, the reason we don't have to worry about MEV or MEVL on the layer 1 is because we're going to have centralized sequencers. And the centralized sequencer is going to be able to like protect, be like a stopgap from the L1 miners being able to like, you know, do a bunch of MEV and create centralizing forces on the miner set.
Makes sense.
But then users are trusting one guy to not like front run them and
Right. The trade-off
the, like,
is one person's making the decision.
Oh yeah, the centralized sequencer like doesn't do MEV, but it just doesn't do MEV because it has a social contract with the users. And if people are fine with that social contract, that's totally cool. So I do agree that a lot of applications and different things will have centralized sequencers, and that's probably totally fine. But for most projects, they're going to want to decentralize it. They're going to want to have a little bit more censorship resistance. Let's say you do a stablecoin protocol, right? Like Liquidity. And it's censorship resistant in the sense that you don't have like a centralized asset being the collateral for the stablecoin. Well, what if you want to add privacy to that? What if you want to have the payment not be on this like completely account-based public ledger that everyone can see the balance of? Well, maybe let's add like a payment pools implementation, like a railgun style implementation where you can deposit your stablecoin into the smart contract and transact within the smart contract and have like that really high level of privacy. What happens if the government doesn't like that? Then it tells the sequencer to censor all the transactions because the sequencer is based in some warehouse in New York. Like these are like things we have to think about. Like if we're trying to build like trust minimized, censorship resistant systems that have actual use cases that are not, for lack of a better term, just propagating the surveillance system.
For the bridge is only half the battle, basically. Like you need the execution environment.
Yeah, it's like there's one, you need the bridge, and then the second problem we have to figure out is like how can we make this system censorship resistant, and how much can we scale the system? So that like that's one problem I have with like the argument for centralized sequencers. One, yeah, I get they're probably not going to do MEV because of the social contract. Doesn't mean they can't. Doesn't mean they won't. And we don't have any implementations of forced inclusion and users being to self-propose their own blocks. And additionally, for for a lot of applications that people are proposing is like the real use cases of bringing finance on chain is like, yeah, you're probably going to want to have some level of privacy. You're going to want to have some level of censorship resistant, and a centralized sequencer simply cannot provide that. So my argument is like they're going to have to decentralize the sequencer eventually. And what is the best way to decentralize the sequencer?
Tokens?
You build another blockchain with its own token. So
is that the best way to decentralize the sequencer? Let's break that down. I mean,
I would argue,
couldn't you just use Bitcoin? That would say what David Sorow would say. Can't you just use Bitcoin as the incentive for the operators? Just like front load some liquidity and like put some money that like people like will use as fees to the operators, and that's what motivates the operators in this decentralized sequencer system.
So here's the problem with that. So let's say like technically we can do that. The staking side of Bitcoin is a little bit hazy to me. I think right now to enforce like slashing, you need like essentially a committee anyways. So you're still reliant on like, I think my understanding of staking is that like there's a federation somewhere down the line and you're relying on that federation somewhere down the line. I think the BitVM people are starting to argue that, I've seen it on Twitter, that they're arguing they can do like more trust minimized like proof of stake systems, or stake chain like systems. I think like a number of projects are working on that. So let's say we solve that problem. This is not a technical thing. This is like a social thing. What happens when another rollup is like, oh no, we're just going to use our own token? Why would the operators who are going to be the professional business operators running these sequencers, like why are they going to work with you and not work with the project that launched a token that's going to make them way more money?
So it just goes back to but these are shitty incentives, right? I mean, these are problematic incentives.
I don't know if they're problematic because that's what's happening, right? The reason it's like, okay, why do you become a node operator?
So it's sort of like a fundamental challenge. I mean,
like the easiest thing to do would be to launch like some proof of stake system. Let's say it's like Comet BFT, right? Delegated proof of stake. You launch your own token, all the validators, get it distribution upon launch, and then like that's the incentive they have to not like be
But
bad actors.
the
Like,
incentive fundamentally is to get access to a token that's going to be like number go up because it's, you know, lower market cap and has more upside. That's like by definition a short-term situation, right?
I mean, but like again, like that is not that's what people are gonna do, and the best way, like it's better. So here's
No, I'm gonna go.
but here's the other thing: if you're launching like a governance token, which I think are like I think they're completely useless, right? It's like, oh, we have this token and we all get a vote, and it's like, oh, well, the vote, like 3 people own like all the money and they can buy more money to make the vote go their way. And I think that's no, let's like at least if you launch a token along with like a consensus protocol that does something, like let's say a decentralized sequencer, like that is a much better use of the token than like some fake regulatory arbitrage way to issue like voting shares in the system. Like that's what I would argue. But nonetheless, like they're somewhere down the line, I think if one, I think they're all going to do it. So I think the argument of like, oh no, we're going to just use Bitcoin, I'm not convinced. If that happens, like awesome,
Great.
like amazing,
Yeah.
right? Like I there
The incentives of that being
like
a real.
people could clip this and then like have like a gotcha moment, like, oh, we didn't launch it. Like great, like I don't want you to. I want people to be able to figure out how to leverage Bitcoin to secure other systems. I want people to figure out how we can do federated or more distributed sequencers with Bitcoin as the collateral token that's slashable. That's awesome. I just don't think that's what's going to happen in practice due to the incentives. What does the VC get out of that? Because the VCs have to get their LPs back.
Gotta pay the VC.
The VCs got to pay their LPs, and the quickest way, and all these VCs are doing really short-term funds, and they got to get that liquidity back to their LPs really fast. So like the quickest way to do that is get a token.
So you're hopeful that David Soroy is right, but you're open to the fact, but you kind of land firmly in the middle on practicality.
I don't want to talk like again, like I do not know. First, like I don't know like if a lot of these projects are launching tokens. I just think they are. I look at who's backing them. I look at the funds involved. Like that's kind of my perspective. And as someone who's raised capital in this space for a company that is not building a blockchain and that is not launching a token, I have realized like how many investors like don't even do like equity investments, which is like totally fine. Like you have your whole setup. That's a game. I have no issues with that. But like
This is the game they play.
this is the game. So like I understand that side of it. So then you have, I guess, the other side of this argument of like we have to launch the token to
And there's many reasons why people feel they need to launch a token, and they may very well right that they need to launch a token to survive in this environment.
and we just covered all of that. But like the other side of this is that if you launched a federation of like 5 sequencers and they all like, you know, and they were placed all in different countries with different rules and whatever, and they all just got made fees and there was enough fees from the system, like that is a sustainable system and is more censorship resistant than arguably any number of the side chains that are being used or rollups in Ethereum. It's even arguably more distributed and decentralized than like Ethereum current L1 block building, because there's like I think 90% of the blocks are built by like 3 entities. So like that is another thing. We could just do federations to do sequencing and pay them in fees. And if the system that gets the most users and accrues the most value makes the most money and provides the most like utility, that's the one that wins. And we don't have to play the token game. So there's, in my opinion, you can have a not decentralized, but distributed sequencer set up in a federation that doesn't need a token, and you don't even need Bitcoin staking. You can just do a federation, and if you can allow the user to bypass that federation, that's totally censorship resistant enough, in my opinion. Or like the centralized argument, I don't think is necessarily true, because one, you could do that setup, and 2, you're probably going to get pressured in practice to do a token. One of your competitors is going to do it, and that's going to make it a lot harder for everybody involved. So, and if you look at a lot of these systems, they have all already launched tokens.
Yeah.
And they just haven't sent them out to everyone yet.
Yeah. Oh man. Okay. Ending on a juicy note. There's so much more that I want to cover with you. We're gonna have to do a part 2 in Denver. We're gonna do it in Denver with your partner Red. Hopefully he'll come and join, because I want to talk more about Meevil, and I want to, which is like my favorite word. And I have like many other like more questions about sort of what makes a good L2, and there's just like much more to cover that we didn't even get into.
No,
So
totally cool. Let's do round 2 and done.
thank you so much. This is awesome. Thank you.